Hi guys, welcome back to the session. Let's have a quick revision of Indian Accounting Standard 38. Before start, I would tell you one thing. If you want good amount of clarity, you may please go with our comprehensive revision lecture that is already available in our YouTube channel. Because this session is going to be a little fast. Clear? So let's start. Firstly, as we know, this standard is applicable to all intangible assets. However, there are some exceptions. What they are? Intangible assets covered by other standards. For suppose, leases of intangible assets. Intangible assets held for sale in the ordinary course of business means what? They are inventories to that particular entity and they are covered by Ind AS 2. Consequently, they are scoped out of Ind AS 38. These are just an examples. Other intangible assets that are covered by other standards are also scoped out of this standard. Clear? And financial assets, as we know, there are big standards to deal with financial assets. They are also scoped out of this standard. And exploration and evaluation assets, expenditure on development and extraction of minerals, oil, natural gas, and other similar resources. These are also scoped out of this standard. But note that if any intangible asset that is covered by this standard is used for point number C and point number D, I can say that for mining business, so that intangible asset is covered by Ind AS 38 only, not covered by these standards. Clear? And one more thing, if any rights granted under licensing agreements for items like motion picture films, video recordings, plays, manuscripts, patents and copyrights are covered by Ind AS 38 only. They are not covered by Ind AS 116 leases. Clear? And coming to the definition of intangible assets, standard is saying that it is an identifiable non-monetary asset without physical substance. Identifiable non-monetary asset without physical substance. Very simple and single line of definition. Correct? But in order to identify an asset as an intangible asset, firstly we need to understand what is the meaning of identifiable asset and what is non-monetary asset and what is the concept of physical substance. Correct? So let's discuss one by one. Firstly, identifiable asset. An asset is said to be identifiable if it belongs to either of these two criteria. First one, if that asset is separable, yes, we can say that it is an identifiable asset. Separable means what? We can separate it from the entity. We can divide it from the entity either by sale or exchange or transfer, either individually or together with other related items. For suppose we are having some patent rights and software. Can we sell that? Yes, we can sell. We can transfer. We can exchange. Correct? So we can say that these are separable. For suppose internally generated goodwill. Can we sell that? Can we transfer that? No. In order to sell internally generated goodwill, we should sell our entire business. So that is not separable. So we can say that internally generated goodwill is not an identifiable asset. And one more thing, if an asset, even that asset is not separable, we can say that that is an identifiable asset if that asset arises from any contractual or legal rights. The best example I can tell you is telecom licenses granted by the government and mining rights as well, because this comes from contractual or other legal rights, right? And what is non-monetary asset? As we discussed, intangible assets are non-monetary asset. We studied in Ind AS 21, correct? What is monetary asset and what is non-monetary asset? Monetary asset means what? These are the asset from which holder entitled to receive fixed or determinable amount of money. For example, trade receivables, correct? From trade receivables, we are entitled to receive fixed amount of money. If you take plant and machinery as an example, can we get fixed amount of money from plant and machinery? May or may not. Majorly, I can say no. No is the answer. Because we derive economic benefits from usage of the plant and machinery. It may or may not equals to fixed amount of money. From this discussion, I can say that non-monetary asset is an asset that does not entitle the holder to receive fixed or determinable amounts of money. So that is non-monetary asset. Our intangible asset is also non-monetary asset. What is the meaning of asset first? We are studying this from CA foundation level, correct? What is an asset? Basically, it is a resource controlled by the entity as a result of past event. From that resource, future economic benefits are expected to flow to the entity. That is an asset. What is the meaning of control? Because we said that it is a resource controlled by the entity, correct? What is control? Control means, on one hand, entity should have the ability to get the economic benefits from that particular asset. On the other hand, entity should have the capacity to restrict others from accessing that particular asset. Then only we can say that an entity is having control over that particular asset. Clear? One example I can tell you. For suppose generally companies provide staff training, correct? Companies provide training programs to their employees in order to increase their efficiency. Thereby company gets the economic benefits, right? So in this story, definitely company incurs staff training cost. The question is, can we recognize that staff training cost as an asset? We should not. Why? Because we are not having the control over that employees. We are not having the control. Why? Employees can resign. Employees can choose other employers, correct? On the other hand, we don't have the ability to restrict other employers as well to hire them, correct? So we can say that staff training cost is not an asset. And what is the meaning of economic benefits? Economic benefits means because of that particular asset, we are able to generate the revenue either by sale of goods or for providing services. And also, we may save the cost because of that particular asset. We are able to cut our cost, or simultaneously both can happen, or any other benefits that we get from usage of that particular asset. So these are economic benefits. Are you clear with this? And coming to the physical substance, as we discussed, intangible assets is a non-monetary, it is identifiable non-monetary asset without having physical substance. It means what? It is by their inherent nature, they don't have the physical substance. However, some intangible assets contained in physical substances, physical devices. So it means what? They are having both tangible elements as well as intangible elements. So in that kind of situations, how to decide whether it is a tangible asset or intangible asset? Standard is saying that it is a subject matter of judgment. It is completely based on judgment, and we should consider which element is more significant. If tangible element is more significant, definitely it is not an intangible asset. If tangible element is not significant, I mean intangible element is more significant, in that case we can say that it is an intangible asset. Correct? For example, we store the software in disk or pen drive, correct? So pen drive is not significant, software is significant, so that is an intangible asset. Similarly, for suppose we are a pharmaceutical company and we are having some patent rights or licenses in connection with our medicine. So where we store that patent rights, we code in legal paper, correct? So that legal paper is not significant. Our license is significant. So we can say that it is an intangible asset. Clear? And one more thing, computer software. If computer software is an integral part of hardware, in that case, we should recognize that entire system as tangible asset only. That's why we see computer or laptop in property, plant and equipment classification, correct? Best example is operating system, our Windows, for suppose. Can we run our computer without Windows? No, it is an integral part. So we should recognize it as property, plant and equipment. And other softwares like antivirus software, artificial intelligence tools, without them we can run our machine, correct? So we can recognize them as intangible assets. Are you clear with this? So still now we have discussed about scope of this standard and definition of intangible asset, correct? So once an asset satisfies the definition of intangible asset, subjected to scope of the standard, if that intangible asset satisfies this recognition criteria, we can recognize that as an intangible asset in the books of accounts of the company. What is the journal entry for that? Intangible asset account debit to bank or vendor account. Right? So what is the recognition criteria? It is probable that means what? More likely to happen. I can say that more than 50% chances that future economic benefits that arise from that particular intangible asset should flow to the entity, and cost of that intangible asset can be measured reliably. If these two conditions are satisfied, yes, you pass that journal entry. You recognize that, no problem. Are you clear with this? And one more thing I would like to tell you is, all these points, all these expenses we should not capitalize, and this is very important for your examination point of view, correct? What I am saying, all these expenses we should not capitalize. we should charge to profit and loss account as an expense. So what is that? First one, expenditure on research. It means what? Research expenses. Research expenses we should not capitalize. However, there is one exception. What is that? In case of business combination transactions, on the date of acquisition, if acquiring entity is having any in progress research expense, that we can capitalize on the date of acquisition. After acquisition, if we continue that research, obviously we incur a research expense, correct? So that research expense we should not capitalize. I hope you are clear with this, correct? And next one is expenditure on startup activities. These are initial inauguration type expenses that we should not capitalize. Expenditure on training activities, we already discussed with good example. Training costs we should not capitalize. Expenditure on advertising and promotional activities, they are operating in nature, so we charge to profit and loss account. Expenditure on relocation or reorganizing part or whole of the entity, operating in nature, charge to profit and loss account, right? So what we have discussed till now, scope of this standard and recognition principles. Yes, our intangible asset satisfies the definition of intangible asset as well as recognition criteria. That is fine. Now we pass it the journal entry for recognizing intangible asset account. Intangible asset account debit to bank or vendor account. This is fine. Till now we have discussed at what amount that intangible asset should be recognized. That is our next discussion. So standard is saying that recognize at cost only. Recognize that intangible asset at cost only, no other amounts. Sir, how to determine the cost? It is completely based on mode of acquisition of intangible asset. How you acquired that intangible asset? Whether you acquired a ready-made intangible asset that is available in the market, or you acquired in connection with business combination transaction, or you got any government grant in connection with intangible asset, or it is internally generated goodwill or internally generated other intangible asset, or you acquired that intangible asset by exchanging your own intangible asset. So we will discuss that cost, that amount for each case one by one. Okay, let's start. First one, separate acquisition. Separate acquisition means what, sir? There is a ready-made intangible asset available in the market. We are purchasing that either on cash or credit basis. That's it. So standard is saying that purchase price you capitalize, non-refundable duties and taxes you capitalize. If they are refundable in nature, we should not capitalize. And don't forget, reduce the trade discounts and rebates, but cash discount we should not reduce. And one more thing, any directly attributable cost we can capitalize. Directly attributable cost means what? These are the costs we should incur in order to get our intangible asset for intended condition. Okay, I mean intended working condition. Right? So that is the cost we should capitalize. Standard has given few examples for that. Have a look. Employee benefit costs, salaries and wages that are directly related to bring that asset to the working condition, we can capitalize. Professional fees. In order to make it working condition, we may need professional consultation. So whatever the cost we incur, recognize, capitalize. And cost of testing, these are basically trial run expenses that also we can capitalize. And these are the examples that are not directly attributable costs. What they are? Cost of conducting the business, they are operating costs, charge to profit and loss account, administration and other general overheads expense. And next one, cost incurred in introducing new product or service. What means? It is an advertisement expenses or promotional charges. So charge to profit and loss account, all these expenses, because they are not directly attributable costs. And one more thing, payment deferred beyond normal credit term. What does it mean? Simply, I can say that generally credit period is all about 15 days, 30 days, 45 days, 60 days, hardly it is 3 months, correct? Beyond that, for suppose, if we acquire an intangible asset, for that we are going to make the payment at the end of second year, let's assume. It means what? It is, obviously it is a abnormal credit period purchase, correct? So that purchase consideration, whatever the amount we are going to pay to the vendor includes interest cost. So that interest cost we should not capitalize. We should charge to profit and loss account as an expense. That is fine, sir. Then what about initial recognition amount? In that case, standard is saying that initially recognize at cash price only. Cash price means what? If we purchase that intangible asset on cash basis, how much amount we need to pay on the date of acquisition? So that is the cash price. If cash price is not available in the question, you calculate the present value of future payments. How much amount we are going to make the payment at the end of second year. To that amount, you calculate the present value today. So that is the amount at which you can initially recognize. Right? Sir, we are discussing about what are all the costs that can be capitalized and what cannot be capitalized. That is fine. How long we should capitalize? Is there any point after which we should cease the capitalization? Yes, standard is saying that. Once an intangible asset is in the intended condition, any cost incurred thereafter, we should not capitalize. We should expense to profit and loss account. So that is what the standard is saying. Are you clear with this? And next one is, these are the examples standard has given for that. Have a look once. Cost incurred in using or redeploying the intangible asset. Means what? They are operating expenses. Second one, what is this? For suppose on 1st July 2025, our intangible asset is in the intended condition. On 1st October 2025, entity put that intangible asset for usage. So out of these two dates, which date is relevant? 1st July 2025 only. So any cost incurred after 1st July 2025, we should not capitalize. 1st October 2025, it is not relevant. Right? It is not relevant. It is a just trap to confuse you in the exam. Okay? And next one, initial operating losses, we should not capitalize. Charge to profit and loss account as an expense. Okay? Anyways, it is a loss. Right? So with this, our discussion on how to determine the cost for acquisition of a ready-made asset is completed. Right? We determine that cost. Now you recognize intangible asset account debit to bank account. You write that amount. That's it. And next one is acquisition of intangible asset as a part of business combination transaction. Okay, in this case, for suppose we are X Limited and there is a company Y Limited. We are acquiring that Y Limited. Okay, we are acquiring that Y Limited. For that, we are paying purchase consideration and we are getting their net assets. This is the story. For suppose on the date of acquisition, if Y Limited is having any intangible asset, recognize that intangible asset at fair value. That is the first point. Second point, if Y Limited is having intangible asset exists, but it is not reflected in the books of accounts of Y Limited due to any reason. For suppose Y Limited is a pharmaceutical company and it is having some patent rights. Because the company is not going to get any future economic benefits from that particular patent rights, the company written off that patents. Because of that reason, that patent is not appearing in the books of accounts of the Y Limited. Now, at the time of acquisition, we got to know that patent exists, but it is not reflected in the books of accounts of Y Limited. No problem, sir. You recognize that patent right also separately from goodwill if that patent right satisfies the recognition criteria. Are you clear with this? Why should we recognize that patent right separately from goodwill? Because if we don't recognize that patent as a separate intangible asset, what will happen? Fair value of net assets will reduce and thereby goodwill amount will increase. So it will sit in the name of goodwill and that goodwill we cannot amortize. That goodwill sit permanently, correct? That goodwill sit in our balance sheet permanently. So that is the reason behind why we should recognize that patents, that intangible asset not appearing in the books of accounts of Y Limited, we should recognize separately. Are you clear with this? And next one, for suppose there is a in progress research and development cost in the books of Y Limited. So that in progress research and development cost can also be recognized as a separate intangible asset. It means what? We can capitalize that only if that research and development project satisfies the definition and recognition criteria of Ind AS 38. So have you noticed one thing? We should recognize all these intangible assets separately from goodwill. Correct? Why? As I already said, if we don't recognize them as separately, what will happen? They will sit in the name of goodwill. So goodwill balance increases. That will sit in the balance sheet forever because we cannot amortize the goodwill. I hope you are clear with this. Correct? So with this, our discussion, one more point is there. For suppose, if Y Limited is having some complementary assets like brand name, trademark, logo, these are complementary assets. Complementary asset means what, sir? They work together to generate the economic benefits for the company. So here, brand name, trademark, logo, they are basically work for one objective only, correct? So what the standard is saying that you recognize all that kind of assets as a single asset on the date of acquisition only if that assets are having similar useful life. Okay, they are having similar useful life. See here, similar useful life. Complementary assets, complementary intangible assets with similar useful life may be recognized as single assets. Right? You are clear with this. And next one is acquisition by way of government grant. For suppose if the entity receives any government grant in connection with acquisition of intangible asset, basically that is the subject matter of Ind AS 20. Anyways, we are going to cover separately in separate session. For the time being, you remember that. Recognize that intangible asset at fair value. No, sir, I don't want to recognize at fair value. No problem, you recognize it nominal amount. Nominal amount means what, sir? 1 rupees, 10 rupees, 100 rupees, like that. In addition to that nominal amount, any expense that is directly attributable to that intangible asset also we can capitalize. That's it. This is all about acquisition of intangible asset in connection with government grant. Okay. And next one is exchange of asset. We are acquiring intangible asset by exchanging our own asset. So in exchange transaction, what we do first? For suppose intangible asset A is our asset, intangible asset B is no. Intangible asset is that we are acquiring, intangible asset B is that we are given up. Okay, intangible asset A is we are acquiring, B is we are given away. Right? So this is the example. So what is the journal entry we write for this? We should de-recognize our asset for suppose. For suppose we are exchanging our assets. Okay, what we need to do first? We should de-recognize our asset first. What is our asset? B is our asset. We are de-recognizing at carrying amount. Now we should recognize the asset that we are acquiring, correct? We are acquiring intangible asset A that we are acquiring. At what amount that asset should be recognized? That is our discussion. So standard is saying that you check whether two conditions exist or not. What are that conditions? Whether this exchange transaction is having commercial substance or not, and fair value of either of those assets can be measured reliably or not. If these two conditions are satisfied, yes, you can recognize this asset at fair value. No problem. You can recognize that asset at fair value. Fair value, okay. Which asset fair value? Either asset that we are given up or asset that we are acquiring. Standard is saying that. First preference you should give to fair value of asset that we are given up. Second preference, fair value of asset that we are acquiring. That's it. One more thing here. If fair value of asset that we are acquiring is more clearly evident than compared to fair value of asset that we are given up, in that case, recognize at fair value of asset that we are acquiring. That is what the standard is saying. So, in this case, accounting is completely based upon two conditions, correct? Commercial substance and fair value. Fair value is fine. What is the meaning of commercial substance? Commercial substance means because of that exchange transaction, how our future cash flows are expected to change. How to determine that? Simply, you check the configuration of cash flows of assets that we are given up and the configuration of cash flows of asset that we are acquiring. If the configuration of cash flows are different, in that case, we can say that there exists a commercial substance. Clear? Configuration of cash flows means what? It's nature, timing, risk, amount of cash flows. That's what. For suppose we are having a software and they are having patent rights. We are exchanging. So there is a configuration of cash flows are different. So there exists a commercial substance. For suppose we are having some software A, they are having some software B. We are just exchanging. Both are same. So in that case, there is no commercial substance in terms of configuration of cash flows. In other way, we can check the entity specific value for that two assets. Entity specific value. Entity specific value means what? It is the present value of post-tax cash flows that generated by that particular asset. If the entity specific value of that two assets is different, yes, you can say that commercial substance exists. Right? So what are the journal entries? For suppose there is no cash involvement is there. As we already discussed, firstly you de-recognize your own asset at carrying amount, recognize the asset that we are acquiring at fair value. Fair value preferences we already discussed. First preference is asset given up. Second preference is asset that we are acquiring. If fair value of asset that we are acquiring is more clearly evident than compared to fair value of asset that we are given up, in that case we should recognize it fair value of asset that we are acquiring. So any difference between these two amounts, you charge to profit and loss account. You recognize to profit and loss account, be it a gain or loss. Okay. If cash involvement is there, that skeleton entry as it is you write, de-recognize it carrying amount, recognize it fair value. If you are paying, credit that amount. If you are getting, debit that amount. Difference you recognize in profit and loss account. That's it. For suppose, sir, as you said, commercial substance should exist and fair values of either of those assets can be measured reliably. If these two conditions are satisfied, Yes, we discussed that accounting. If either of those conditions not satisfied, or both conditions not satisfied, in that case, how to do the accounting? Standard is saying that you do the accounting in such a way that there will be no gain, no loss. See here the journal entries, you will understand. For suppose cash involvement is not there. Firstly, you de-recognize your own asset at carrying amount and recognize the asset that you are acquiring at carrying amount of your asset. At carrying amount of your asset, I mean the asset you are given up. In our example, intangible asset A is the acquiring asset, intangible asset B is the asset that we are given up, correct? So this carrying amount of intangible asset B, this is the carrying amount of intangible asset B. Means what? Carrying amount of intangible asset that we are given up. That is the amount at which we should recognize the asset that we are acquiring. Clear? For suppose cash involvement is there. In this case, this will become the balancing figure. The asset we are acquiring will become the balancing figure. Cash involvement is there. As usual, you de-recognize your own asset at carrying amount. After that, if you are receiving the payment, debit it. If you are paying the payment, credit it. This will become the balancing figure, so that no gain, no loss can be recognized. Right? So with this, we are completing our discussion for determination of cost for all these modes of acquisition. Correct? Is there anything left? Yes. One more thing is there, correct? What is that? Internally generated goodwill and internally generated intangible assets. About internally generated goodwill, we have already discussed at the time of discussion of definition of intangible asset, correct? Internally generated goodwill is not separable. So it is not an identifiable asset. So it is not satisfying the definition of intangible asset. So we should not recognize internally generated goodwill. Then what about other internally generated intangible asset? Standard is saying that yes, we can recognize other internally generated intangible asset only if they satisfy the additional recognition criteria. And standard is divided the generation process into research phase and development phase. Whatever the cost we incur during the research phase, we should charge to profit and loss account as an expense. We should not capitalize. And development expenses we can capitalize if the development process fulfills the recognition criteria. I mean the additional recognition criteria. If the entity cannot differentiate between what is the research phase and what is development phase, all expenses that we incurred should be treated as research expense only. It means what? We should not capitalize. That is what the standard is saying. And one more thing, other internally generated intangible assets like brands, mastheads, publishing titles, and a customer list, these do not qualify for recognition of intangible asset. Why? Some of these kind of assets don't satisfy the definition of intangible assets. Some are satisfying the definition of intangible assets, but they are not satisfying the recognition criteria, especially due to we are not able to measure their cost. So this kind of intangible assets we should not recognize. So let's discuss what is research phase and what is development phase. Research phase means what? It is an investigation. Research is nothing but an investigation to acquire a new knowledge or new understanding, maybe about a new product or service, or for improvement of existing product or service or system or process, whatever it may be. So whatever the expense we incur during the research phase, we should not capitalize. We should charge to profit and loss account as an expense, even if that research is going to be successful. Why we should expense? Because from research phase, it is not probable that we are going to get any economic benefits unless research is successful and development phase start, and development phase is also successfully completed. We cannot get any future economic benefits, correct? So that is the reason behind why we should not capitalize research expenses even it is successful in future, right? And coming to the development phase means what, sir? Basically it is application of knowledge that we got, application of result that we got from the research phase, be it either for designing a new product or service or improvement of existing product or service or system process, as the case may be. This story is all about before they are commercially produced, before they are commercially used, correct? So what we discussed, yes, any expense that incurred during the development phase can be capitalized only if that satisfies all these 6 conditions. What they are? Entity should prove that It is technically possible to complete the intangible asset for making it available for use or sale. And entity should have the intention to complete, and after completion, it should use it and sell it. Okay, it should have the intention to use it or sell it after completion. Not only intentions are, entity should also have the ability to use or sell it after completion. And in addition to this, entity should have the adequate resources to complete the development process. Be it a financial resource or human resource or any other infrastructure or any other resource that is necessary to complete the generation process. And fifth condition and sixth conditions are general requirements only. What is that? Entity should show that how intangible asset will generate the future economic benefits, and that development cost we should measure reliably. If all these conditions are satisfied, yes, we can recognize, yes, we can capitalize the expenses incurred during the development phase. Are you clear with this? And one more thing is, for suppose on 1st April 2025, we are starting the development phase. It means what? Just because we are starting the development phase on 1st April 2025 doesn't mean all conditions are not satisfied. All conditions are satisfied. If all conditions are satisfied on that date, any expense we incur thereafter, we can capitalize. For suppose, one more example. On 1st April 2025, we are starting development phase. On 1st October 2025, all six conditions satisfied. So in this case, which date is relevant for starting capitalization? 1st October 2025 is relevant. So whatever the expense we incur during the period 1st April 2025 to 1st October 2025, that we should not capitalize. We should charge to profit and loss account. That's it. Right? And after 1st October 2025, any expense we incur, we can capitalize. Okay. And one more thing is, expense that previously we charged to profit and loss account should not be capitalized because six conditions are satisfied, right? See here, note point. If any development expense is charged to profit and loss account due to non-fulfillment of any condition, it can never be capitalized again, even if conditions are satisfied subsequently. That is what the standard is saying. And one more thing, we discussed that when should we capitalize the expense and when we should not capitalize the expense. That is fine. What kind of expenses we can capitalize and what kind of expenses we should not capitalize, that is the discussion. So what standard is saying that all directly attributable costs for that development phase in order to generate the intangible asset can be capitalized. This is very similar to self-construction of property, plant and equipment, sir, I can say. This is very similar to self-construction of property, plant and equipment. So see here the examples. Cost of materials, services used, consumed in generating the intangible asset. Yes, they are very, very essential to capitalize it. Cost of employee benefits, salaries and wages that are directly connected with the development process, you capitalize it. Fees to register a legal right. Okay, for intangible asset, we should register with government authorities. So that cost you can capitalize. Amortization of patents and licenses that are used to generate the intangible asset. In order to generate our intangible asset, if you use any patent or licenses, amortization charge of that patents and licenses can also be capitalized. That is what the standard is saying. And cost exclusions, you can express this. You can guess this: selling expenses, administration expenses, other general overhead expenses we should not capitalize. And cost of identified inefficiencies or initial operating losses, this should not capitalize, you know. And staff training costs also, you know, that we should not capitalize. So till now what we have discussed is about only to the extent of passing that journal entry, intangible asset account debit to bank or cash account amount. So we determined the amount for different modes of acquisitions. Now we initially recognized our intangible asset, that is over. So what next? After such initial recognition, if we incur any subsequent cost, after that initial recognition, if we incur any subsequent cost, that cost also be eligible for capitalization if it generate additional future economic benefits. Otherwise, you charge to profit and loss account as an expense. That's it. So until now we have discussed about initial recognition and subsequent cost. Correct? So next one is, at what amount we should carry our intangible asset for the end of reporting period or for subsequent periods. So that is our discussion. Standard is saying that For that subsequent measurement, either you can follow cost model or revaluation model. Whichever model you are going to follow, that will become an accounting policy, and that policy we should apply consistently to the entire class of intangible asset. Class of intangible asset means what? Assets are having similar nature and similar usage. For suppose we are having software and patent rights, they are not having similar nature and similar usage, correct? So you can apply different models for that. For suppose we are having three softwares, software A, software B, software C. These are all having a similar nature and usage, correct? These softwares are all having similar nature and similar usage. So in this case, you should apply either cost model or revaluation model. Only one model you should apply. For suppose, if you are following revaluation model for all that three softwares, if we are following revaluation model for all that three softwares, for suppose software C is having no active market, in that case standard has provided one exception. No problem. For first two softwares you can follow the revaluation model. For third software C, you can subsequently measure at cost model. As per cost model, you can subsequently measure that software C. For suppose we are successfully revaluing that asset. For suppose we are in fourth year. In fourth year, one software is not having active market. So in that case, no problem. You can measure at previously revalued amount minus subsequent amortization minus subsequent impairment loss. That is what the standard is saying. In that case, we should go for impairment testing because it is indicating, correct? It is one of the indication of impairment testing. So we should go for impairment in that case. And one more thing I would say that till now we have applied cost model for subsequent measurement of our intangible asset. But now I want to apply the revaluation model. Can I say this is a change in accounting policy? Yes, it is a change in accounting policy. So what the standard is saying that in this case, retrospective accounting is not required. You apply the revaluation accounting prospectively and that is sufficient. That is what Ind AS EIT is saying, right? So coming to the calculation part, at what amount we should recognize our intangible assets. In case cost model, simply you write the amount that we determined on initial recognition. From that reduce the accumulated amortization. If there is any indications of impairment exist, you calculate the impairment loss, you reduce that, resultant amount will become your carrying amount. If it is a revaluation model, simply you write the fair value on the date of revaluation. From that reduce the accumulated amortization subsequent to revaluation date. We should not reduce accumulated amortization prior to revaluation date. Okay, and the same with impairment loss. Resultant amount will become your carrying amount at which you can carry your intangible asset in your books of accounts. I mean the balance sheet. Okay, sir, just because you are following revaluation model doesn't mean you should go for revaluation every year. Standard is saying that if fair value fluctuations of your intangible asset is significant and volatile, then only you go for annual revaluation. Otherwise, you should not go. Revaluation once in 3 years or once in 5 years is suffice in that case. Okay, at the time of you are going for revaluation, you decided that be it annual or once in 3 years or once in 5 years. At the time of you are going for a revaluation, on that date, if you find that carrying amount of your intangible asset is not materially different from your fair value of the asset, in that case revaluation is not required. This is the primary objective of revaluation model. See here, revaluation model primary objective is what? To ensure that carrying amount of intangible asset does not materially different from fair value. So what I said, on the date of revaluation, if your carrying amount of intangible asset is not materially different from fair value of your intangible asset, in that case, revaluation is not required. If it is materially different, yes, you should go for revaluation. So that is what the standard is saying, right? And after revaluation, yes, it is materially different, you revalued. When after revaluation, the carrying amount of your intangible asset is materially different from fair value, you go for further revaluation. So that is what the standard is saying. Right? So how to deal with revaluation accounting? If it is a first time revaluation and that gain on first time revaluation we are getting a gain, recognize in OCI section that will accumulated in equity under the heading revaluation surplus. If it is a loss, charge to PRL section, that's it. And subsequent revaluation, earlier there is a gain, now also gain, simply you do the same. Recognize in OCI section, it will accumulated in equity under the heading revaluation surplus. There is a loss, before there is a loss, now also loss, so charge to PRL. There is a gain, last time there is a gain, now it is a loss. Simply you recognize this loss in OCI section to the extent of previous revaluation surplus. If any loss still exists, that you charge to PRL section. That's it. Earlier there is a loss, now it is a gain. It is quite opposite to previous one. So this recognize this gain in PRL section to the extent of previous revaluation loss. Any gain still exists after that you recognize in OCI section. And we are having one more obligation. If we are following revaluation model, at the time of derecognition of intangible asset, if any revaluation surplus balance exists in respect of that particular intangible asset, we should transfer that amount from revaluation surplus to retained earnings. Revaluation surplus to retained earnings. Or alternatively, at the time of derecognition is not required. Every year you do that to the extent of additional amortization due to revaluation. So as you know, if we get any revaluation gain, thereafter definitely our amortization charge will increase, correct? So what the standard is saying that to the extent of that increased portion, to the extent of that additional amortization charge, you transfer from revaluation surplus to retained earnings every year. This is alternative and this is first one, and this is the alter. And how to deal with accumulated amortization account in case of revaluation? Standard has provided two alternatives. First one is you simply eliminate the balance in accumulated amortization account. You adjust that balance with the gross carrying amount of intangible asset. And second one is restatement approach. So let's discuss with numbers so that you can get good amount of clarity. For suppose initial cost 1 lakh rupees, accumulated amortization 55,000 rupees. It means what? Our carrying amount is 45,000 rupees, correct? So fair value is 65,000 rupees on the date of revaluation. It means what? 20,000 rupees our revaluation gain. So in this case, first method, elimination of accumulated amortization balance, right? You eliminate it. See the journal entry. We are eliminating the accumulated amortization balance that we are directly adjusting to gross carrying amount of intangible asset, correct? And you simply recognize the revaluation gain. See here, we are recognizing the revaluation gain. That's it. Then what about restatement approach? In case of restatement approach, what we should do is we should calculate the percentage of change. I can say percentage of that revaluation surplus or revaluation deficit to the carrying amount of that particular intangible asset. And you adjust the gross carrying amount of intangible asset as well as accumulated amortization account to the extent of that percentage. See the journal entry, you will get good amount of clarity. Here intangible asset, it is having a gross carrying amount of 1 lakh rupees, correct? So you increase. In our example, this is revaluation gain. So you increase to the extent of that percent. So we are increasing. And similarly, you reduce that accumulated amortization. Accumulated amortization also we should increase. See here, we are increasing. Accumulated amortization 55,000 into 44%. Because it is a revaluation surplus, we are increasing that balances. If it is a deficit, we should decrease. So that it will become 65,000 fair value. Fair value means what? After revaluation, it will become our carrying amount on the date of revaluation, correct? So this is the balancing figure and that will become our fair value gain. And next one is useful life. As you know, accounting for intangible assets is completely based on useful life, correct? If the useful life is indefinite, means what? How can we amortize? We cannot amortize. We should go for impairment test every year. If it is a finite useful life, it is having finite useful life, yes, we can amortize. So what is the meaning of intangible asset that is having indefinite useful life? I can say that that kind of intangible asset generate the economic benefits forever. There will be no foreseeable limit. If intangible assets are having a finite useful life, it means what? They generate the cash flows for a limited period. For suppose if intangible asset arises from any contractual or legal rights, in that case, useful life of that particular intangible asset should not exceed contractual period. It can be lower than contractual period, but it should not exceed contractual period. If the contract is having renewal option, yes, we can include that renewal period also in useful life, only when the cost of renewal is insignificant. If the cost of renewal is not significant, if the cost of renewal is significant, in that case, we should not include the renewal period in the useful life. Okay, are you clear with this? For suppose in business combination transaction, we are reacquiring our right. Before business combination, for suppose there is a Y limited and we are X limited. We transferred our, we are a brand restaurant in the market We transferred a franchisee. We have granted a franchisee right to Y Limited for 10 years, for suppose. And in this contract, we have granted a renewal option also after 10 years. This is the story. For suppose, at the end of sixth year, we are acquiring that Y Limited. It means what? We are reacquiring the right that we have granted, correct? So, what standard is saying that useful life of that reacquired right is the remaining contract period. In our example, 4 years, correct? So in this useful life, we should not include the period of renewal option. That is what the standard is saying. Now you are clear with this, correct? And coming to the amortization, it is similar to depreciation charge for property, plant and equipment. What is it? Systematic allocation of depreciable amount of intangible asset over its useful life, and that amount we should charge to profit and loss account. That's it. What is depreciable amount? If it is a cost model, original cost minus estimated residual value. If it is a revaluation model, substituted fair value minus residual value. But note that in case of intangible asset, we should assume that residual value of intangible asset should be 0. However, there are exceptions. What they are? If there is a third party commitment to purchase our intangible asset at the end of useful life, or when there is an active market for that intangible asset at the end of its useful life. In these two situations, yes, we can take the residual value. In any other case, residual value will become 0. As we know, in this formula, residual value and useful life both are estimated, correct? They are estimations, not actual numbers. So what the standard is saying that at the end of each financial year, we should review that estimations, be it a residual value or useful life. In that process, if we noted that any change is there, that change should be accounted as change in accounting estimate as per Ind AS 8. And as we already know, we should charge the amortization when the asset is available for usage, not when the asset is actually put to use. That you already know, correct? And what about the method of amortization? The standard is not rigid about method of amortization. It should clearly reflect the pattern of consumption of economic benefits from that particular asset, and that method, our amortization method should reflect that pattern. And we should apply that method of amortization consistently from one period to another period. For suppose, if you are not able to determine the pattern of consumption of economic benefits of that particular intangible asset, in that case, no problem. You follow the straight line method, that is sufficient. That is what the standard is saying. And for this method of depreciation also, we should review at the end of each financial year. On that review, if notice that if there is any change in pattern of consumption of economic benefits, we should change our method of depreciation also to reflect that changed pattern. And that change is also called as change in accounting estimate. We should treat that as a change in accounting estimate as per Ind AS 8. I can say that if economic benefits, consumption of economic benefits are uniform, you follow straight line method. If they decrease over a period of time, follow the written down value method. If they are linked with production units, you charge the amortization on the basis of units of production. Clear with this? And there is one exception. What is that? Generally, revenue-based amortization is not appropriate. Amortization charge on the basis of revenue is not appropriate, but there is one exception. What is that? If intangible asset is itself measured in terms of revenue, or revenue and economic benefits consumption both are correlated, in that case, we should go for amortization on the basis of revenue. The best example is, for suppose we have obtained a toll collection right from any national highway. Definitely we pay the cost. For suppose 50 lakhs is our cost of that right. And that right granted us to collect the toll charges to the extent of 2 crores. It means what? Our right is measured in terms of revenue only. Na? So in this case, we can charge the amortization on the base of revenue. For suppose in the first year we collected 50 lakh, second year 60 lakh, third year 40 lakh, and next year some amount. You charge the amortization on the base of proportion of this revenue. That is what the standard is saying, right? And next one is amortization of intangible asset will cease at the earlier of the following dates. What is that? When intangible asset is classified as held for sale or included in the disposal group that is classified as held for sale. It means what? At the moment Ind AS 105 is applicable, that date or the date of derecognition of intangible asset, whichever is earlier. From that date, we should cease the amortization. And amortization charge is 0 when we charging the amortization on the basis of units of production. For that particular year, when there is no production, amortization is also 0. And one more thing, residual value is greater than carrying amount. In this case also, amortization is 0. As we already discussed, residual value we should assume as a 0. except two cases. What that are? When there is a third party commitment to purchase the intangible asset at the end of its useful life, and when there is an active market at the end of the useful life. In these cases, we take the residual value number. If the residual value number is more than carrying amount, obviously there is no amortization, correct? So amortization will be zero, right? And now the favorite area came. What is that? Intangible asset with indefinite useful life. We are getting economic benefits for unlimited period. For everyone, this is favorite area only, correct? We should not amortize it. Instead of that, we should go for impairment as annually, and whenever there is indication that impairment conditions are existed. Are you clear with this? And one more thing, we are having one obligation in respect of this asset. At the end of each year, we should review this, whether the useful life is still indefinite or it changed from indefinite to finite. If it changed, we should treat that change as change in accounting estimate as per Ind AS 8. Are you clear with this? What I am saying, in process of reviewing whether the useful life of this intangible asset with indefinite useful life is changed or not, we found that it is changed from indefinite to finite. In that case, we treat it as a change in accounting estimate. That is what the standard is saying. And last one is derecognition of intangible asset. When we should derecognize the intangible asset? When disposed, when no future economic benefits are expected from it, you derecognize it. Derecognize it carrying amount. Difference between any sale proceeds. If no sale proceeds, total amount you charge to profit and loss account. That's it. So with this, our revision on Ind AS 38 is completed. Okay, see you guys in the next session. Bye bye.